my best, everybody. We're all going a little nuts sitting doing WFH, which will be a new ism, just like we've adapted those isms to our lingo over time. So hopefully we'll see you all in person soon. We've got two great panelists, and I will let them introduce themselves and just say very briefly what their company does, because I think that'll help the context of our discussion as we go forward. Eric, do you want to start off?
Sure, thanks, John. So my name is Eric Benhamou. I'm the managing partner at BGV. We're an early stage venture capital firm headquartered in Silicon Valley with offices in Tel Aviv, Paris, and Bangalore, India. And we invest in early stage enterprise 4.0 type companies who drive digital transformation of industries. And we ventured into the SPAC world about 2 years ago and learned a great deal about this, had a successful de-SPAC transaction a year ago, which I'm eager to share the experience, both pros and cons.
Great. Chris?
Thanks, John. Hi, my name is Chris Ho. I'm an associate director at Vickers Venture Partners. We're also a venture firm. We're a global deep tech focused one looking for science or engineering based breakthroughs. Headquartered in Singapore, but I'm obviously in New York, as you can tell from my background. We recently ventured into the SPAC world, and I'm also the CFO of Vickers Vantage Corp 1, which is the SPAC that our venture fund sponsored, listed on the NASDAQ as of January 7th this year. So happy to share our experience here and look forward to the conversation.
Thanks, all. Just to give you a little bit of context, in 2020, almost 250 SPACs went public. They raised over 83 billion with an average size of about 335 million. To date, so this is as February 2nd, 100 SPACs have gone public, raising 29 billion with an average size just under 300 million. And if we were to assume that pace of issuance continues, by end of year, we'd have 1,200 SPACs with 348 billion of dollars ready to deploy. Just so people realize, this boom in SPACs has really come in the last 2 years. From 2017 to 2019, on average, only 30 to 60 SPACs were issued, and the average issuance per year was 12 billion. Prior to that, there were very few issuance. There had been a SPAC boom probably 10 to 15 years ago, but then it tapered off. Of interest, though, since 2009, 574 SPACs have been issued. Only 26 have been unable to execute on an acquisition and ultimately were liquidated. But in a normal setting, I'd ask everybody in the audience to raise their hands and tell me if they even know what a SPAC is. So can't do that here today. So I'm going to give, because even I'm a little bit ignorant when it comes to SPACs, I'm going to let both Eric and Chris talk about what a SPAC is. Either of you can choose to kick it off.
Sure, I'll start. The concept is really pretty simple. A SPAC is a shell company that raises capital through a public offering, through a classical IPO from public equity investors. And the main purpose of the SPAC, the only purpose of the SPAC really, is to acquire an operating business. And it has to complete that transaction in a finite amount of time, typically 18 months to 2 years. And through this transaction, the net effect is that this private company is taken public. And this is really what so many SPACs, as you mentioned, John, are doing right now.
And are the SPACs typically listed on NASDAQ or New York Stock Exchange or some other exchange?
NASDAQ and New York Stock Exchange have been the most popular exchanges. But technically, there's nothing that precludes other exchanges from being considered.
And Chris, maybe you can talk about, there are all sorts of terms and conditions that, sort of put a limit on the existence of a SPAC. My understanding is, blank check company has a period of time in which to make that type of acquisition.
That's right, John. And Eric kind of mentioned it. The timeline is typically 18 to 24 months. It's a lever, it's negotiable. I've seen SPACs as short as 6, which is very short. 12 to 18 is starting to get common. A few years ago, everyone was doing it at 24, but there's been some pressure lately on this due to the number of SPACs coming out. A couple of the other levers that people can pull, usually when a SPAC issuer offers their units, it's 1 share and some warrant. And whether that's 0, half, or third, or even a full warrant, that's another negotiating lever or an option that they can pull. And then the third piece I would say is the amount of cash that they put into the trust. So again, it's a shell company. You're going out to the public markets. You're trying to raise some pool of money. Let's say 250, just for the sake of argument here. That 250 million goes into a trust that the company can't touch, right? It's for the purpose of the acquisition. But to juice the returns for their public investors, you could say, instead of putting 100% in trust, I will put 101 or 102% in trust to give a little bit of an extra juice to that. So that's one of the other levers that's possible. The last lever I would say hasn't seen much pushback lately is the amount of founder promote or the sponsor promote. Typically, it's set to 25% of the IPO, meaning 20% of the outstanding company, given to the sponsor for their work and the blood and sweat they've put in to get everything together, to find the target, to get through the issuing process, to work with everyone to execute and consummate a deal.
And I'm assuming these SPACs are underwritten by Wall Street houses when they go public. How do they price it? I mean, it's basically a shell company. Is there a standard pricing mechanism?
Yeah, by convention, the units are all set to be $10.
Okay.
So everything is set to be $10. Now, the unit itself may be, say, 1 share half warrant or 1 share 1/3 warrant, but they all come out at $10.
Okay.
And that's
So the
going to be
question-
garbage, right? It just makes the math easier.
Yep. Okay.
It really is. So the question really is for the sponsor, again, you're coming out to try and find a good acquisition for all your shareholders and of course for the target company itself to have the advantage of being a public company. So the question is, what is your deal flow and what are you looking at? Does it make sense to raise $100 million SPAC or a $400 million SPAC? It really depends on what kind of deal flow that you see to actually consummate a deal.
Mm-hmm. And explain to the audience what you can say in that SPAC issuance, because my understanding is it really has to be a blank check company. Can't be, like a roll that you're planning a roll up ahead of time and you've already negotiated a purchase price with a bunch of, small companies and you're going to roll them up all into the SPAC. How come they don't allow that to happen? Eric or Chris?
Yeah, you're right, John. It's when a SPAC is raised, when a SPAC goes public, it is not raised with a very specific transaction in mind. Usually SPACs describe sectors of interest, but not a specific company within that. However, the SPAC sponsors who have absolutely no idea who would be legitimate, viable candidates to approach are going to have a hard time because this 18 months, 2-year period, which Chris and I mentioned, it goes by quite quickly. So you have to have a pretty good deal flow in order to maximize your chances of having a successful de-SPAC. But it should not be so specific as to have pre-engineered a transaction. That's not part of the process.
Okay. And in the old days, when we had the last SPAC boom, it was only hedge funds that seemed to be buying interest in SPACs. How has that changed, or has it changed at all?
Well, in general, the investors who participate in the SPAC IPO are hedge funds. It's a very typical hedge fund bet because basically you have downside protection built in by virtue of the fact that your capital is put in a trust invested in treasuries, as Chris mentioned. But you have an upside option if this is a transaction you like that you want to approve. You have the warrant kicker. So it's a natural vehicle to attract hedge funds. However, what takes place usually between the moment a transaction is announced, the definitive agreement has been approved and publicly announced, and the time of closing, and there could be a 2 to 3 months hiatus between these two dates, there's a significant amount of churn in the shareholder base. It sort of rationalized itself. Investors who like the transaction are buyers into the SPAC, and the original hedge fund investors who don't particularly like the transaction can sell their shares during that time.
So in that transition period, it's almost like you're going public a second time, only with specifics. Can you tell us, what information do you share with your existing investors, but also the potential future investors? Mutual fund companies, widows and orphans. There are a lot of people out there who want to put their money in the stock market.
Yeah, that's a key point, and I'm sure that Chris will also add his viewpoint on this. One of the advantages that SPAC have, particularly when the target company is a high growth technology company, is that the filings that you file with the SEC for this transaction, the S4 filing, gives you an opportunity to communicate a great deal of information about the targets, including projections, something which is very hard to do, in fact, impossible to do if you were to go public using a classical route. So that's an advantage because it enables you to signal more information about the trajectory, the expected trajectory of that company, and attract more investors this way. So that's one of the advantages, particularly for firms like I'm sure Chris's and mine, for VC firms typically investing in high growth companies.
And let's say you find an acquisition, you've raised $300 million, and you find an acquisition candidate that really is only going to need $250 million. Does the surplus cash that you've raised go back, or can you keep it as a deposit for CapEx? How would that work? Chris or Eric?
So this transaction, if you think about it, it's really a reverse merger, right? It's the SPAC entity is the one that's issuing shares to that target acquisition. So that capital just stays within the NewCo. The innovation here, and this is actually key, and just to go back a little bit to why hedge funds are so attracted to this, the downside is very, very protective for the public shareholders into the SPAC entity. They purchase some number of units, and their downside is completely protected because in a trust. And when it comes time for that business combination between the SPAC entity and their target business, they have the right to redeem their shares if they don't like the deal. So the recent innovation and the why many SPACs have successfully made a business combination is because you're now able to add in the pipe investors to this, right? And at that point, you could swap out from the hedge funds to some long-only guys or some sector-specific guys. If you did, say, a biotech deal, you can get the right biotech long holders for this NewCo, and that provides the security of the deal. Because as a sponsor, you can't control the redemption, right? You don't have any say on what they decide to do. But what we've seen recently is that as you there's an inverse correlation. The more pipe, the stronger your pipe, the less likely there is any redemption pressure.
Interesting. Maybe it'd be appropriate at this point in time for each of you to explain the type of SPAC. My sense is both of you had slightly different objectives for issuing a SPAC. And maybe you can give an example, i.e. your experience in what you did with a SPAC, and the motivation behind the issuance and where it's taking your organization.
Sure. I'll start.
Yep.
So the Vickers Venture Fund was actually the sponsor for our SPAC. So this is called an in-fund structure. And the reason for doing this is because we already see a lot of deals. Vickers Venture Partners has about 40 people around the world. And there was a lot of unutilized deal flow. And we thought this was a good opportunity to add another tool to our toolkit to be actually leveraged against this untapped resource. And the beauty of having it as an in-fund structure allows us to put all of our people to work against it, right? Everyone is very well aligned to the success of the SPAC because they're well aligned to the success of the fund. So that was something that we did. We thought it made a lot of sense given the experience that we have, given the deal flow that we have, and given the expertise that we're trying to go after. We want to continue to use that same deep tech deal flow to bring it to the SPAC. Going back to what Eric was saying, where when you have deep tech companies that are kind of on the cusp of high growth, to get a fair evaluation, you want to be able to think about what they're going to be able to do in the future, what that future potential looks like. And the SPAC opportunity allows them to talk about projections. Again, it's going to be a conversation between the SPAC entity and the target business where it can have, I believe, a fair evaluation for them.
And when you say in fund, does that mean, so thinking about typical GPLP structure, does that mean the SPAC is sort of hanging off of a fund, or is it actually at the management company level?
Yeah, so it's from the fund itself.
Okay.
So Vickers Venture Fund 6 is actually the sponsor for the SPAC.
Yep.
And any upside will accrue both to the GP and the LP since it's part of the fund.
Okay. Eric, how about your experience?
So my experience, just to place it in time, we actually raised our SPAC, did our IPO in October of 2018. So this was before SPACs were cool. And in fact, I did this primarily for the purpose of learning the mechanics and testing the hypothesis that SPACs could be a very good exit vehicle for venture-backed companies. So at the time, the sponsor entity was created outside of the venture fund itself. So it was a sort of an extracurricular but related activity, if you will. In the future, it's very likely that we would do a structure very much like what Chris described. But in those days, SPACs were still a somewhat untested vehicle. So we raised the SPAC in October of 18, and we de-SPACed almost a year ago today.
And again, you de-SPAC because just...
Well, the de-SPAC is basically the transaction where the SPAC required the operating entity. Okay. And it closed on March 5th of 2020. The SPAC was called Chasorg. The name of the SPAC typically disappears in the process of the de-SPAC, and the name of the operating entity, which already has brand value associated with it, is the one that survives. So in our case, it was a Great Dynamics, which has done a very good job during this pandemic year to create value post its entry onto the NASDAQ.
Thank you. One of the questions that's come in from the audience is, well, there are actually two, but I'll try to combine them into one, is let's say you've got a bunch of hedge fund managers who invest in a SPAC. Obviously, they've got to approve the acquisition candidate. Is that a majority vote, or how does that, could you have some hedge fund who feels they're getting a bum deal and file a lawsuit, or how does that work?
Yeah, it is a majority vote, but frankly, as the stats that you mentioned at the opening of the hour suggest, usually these votes get approved. I mean, the overwhelming majority of votes are favorable. What's a little more challenging is to make sure that the redemption level is something that the SPAC can absorb. And as Chris mentioned, these two things are actually decoupled. Mm-hmm. So there's a level of redemption that could jeopardize the transaction itself, because in order to redeem, you have to fund the redemption. And if this is funding that you expect to also fund the transaction or the operating company, then then you can have a conflict. So usually these kind of transactions are no different than if a publicly traded company purchases a significant other publicly traded company. That requires shareholder approval, usually a simple majority.
Okay. Okay.
And just to add, the decoupling of that is an important step. I think, a decade ago when SPACs were first maturing, that hadn't been decoupled yet, and that has really allowed the SPACs to take off. I think it's part of the reason why.
Mm-hmm. And I was talking to somebody who's on the ILPA, Institutional Limited Partners Association, who is very riled up about private equity firms doing SPACs and sort of a misalignment of interest. Can both of you address sort of your point of view? Is that something that LP should be concerned about? Does it really displace the alignment of interests? And this particular person was particularly upset that the GPs were getting a great promote and that wasn't being shared effectively in his own mind with the LPs. And I suspect it's really how you structure it, but I'll let the two of you speak to that.
You want to start, Chris?
Yeah, I'll start, because from my point of view, there really is no misalignment, right? And that's partly the structure that we chose to take because it's in fun. What is the conflict, right? Any upside that does accrue from the sponsor vote actually goes to our LPs. And as Eric said, he may consider a similar structure in the future, I imagine, for the same reason.
Yeah, no, I agree with that. It's there is perhaps a misconception that a SPAC is easy. Well, raising a SPAC is relatively easy. It doesn't take much, particularly in the state of liquidity of the market today. However, de-SPACing is very challenging. You have a limited amount of time to perform that activity. There's a limited amount of viable targets who can live as a publicly traded entity, who have the stature, maturity, management team, and so on to continue as a public entity. However, there's a reward there. And right now, there is a multiple expansion that typically takes place if you go from being private to being public. That's not always been the case, but right now, publicly traded firms, particularly in technology, benefit from a greater multiple. And I think for the right reasons, because they achieve a level of transparency, professionalism, and so on, that is not demanded of privately held companies. So there's true value being created, and there should be commensurate rewards as well. Keep in mind that if a de-SPAC is not possible or is turned down, the sponsor has to absorb the loss of all the operation that had to be funded during that period, and that's a significant risk. It has to be counterbalanced by a significant reward as well.
Agree with that, and I would add that the misalignment of incentives that I see here is not between any GP and LP, but actually between the sponsor and the public investors. Because as Eric mentioned, the public investors have downside protection, right? Their money goes in a trust, they can redeem it at any time. The sponsor, if they fail to de-SPAC, they lose all of their money. So as that window of opportunity for the SPAC gets closer to the end, they'll be thinking, and they have an incentive to do any deal without regard for what happens to the new co after the business combination. Now, there are ways around that, right? There are other things that you can think about to try and to align those incentives, such as sponsor earnouts for share performance and things like that. But that's really where the misalignment is, not between the GPs and the LPs.
Very helpful. So, since I guess it was 2009, 574 SPACs issued, only 26 had to be liquidated. Given the boom now, what's your feeling as to that sort of ratio of SPACs that may actually have to be liquidated?
My belief is that it is bound to go up. There's a finite amount of viable targets available. There is plenty of capital for high quality targets, and it's not just SPAC capital. private equity as an asset class has record levels of dry powder. So these companies who deserve to go public, who want to go public, will have multiple options. And some of them will choose not to go the SPAC routes for their own reasons. But I believe that there's been such a surge in SPAC interest last year that this low level of SPAC turn down that you reported is probably not going to be sustainable for the next couple of years.
Mm-hmm.
Yeah, you gave some stats at the beginning, John. If you think about the amount of SPAC capital that's outstanding right now, it's like 100+ billion, of which maybe a tenth of that actually has announced a deal. So the rest are still searching.
Right.
So I agree with Eric. I think we're going to see that number go up. People are going to learn the hard way that it's not easy to de-SPAC.
Mm-hmm. Yep. No. One question, sort of, if you're a sponsor, how much money? I think it's like $10 million to get a SPAC going. Is it that expensive or not?
No, not that expensive. I would expect, rule of thumb, 3-4% of the size of the SPAC that you're raising. Mm-hmm. Or put it another way, it's 2% underwriting fee, and call it another 2 million in just other offering expenses and working capital expenses is kind of the ballpark I would land at.
Yeah, that has been our experience as well. So high single digits for most SPACs.
Okay, and we're hearing about continuation funds. Why wouldn't a management company of a private equity firm, sort of from the management company, funded out of the management company, fund a SPAC, and then in essence buy one of the portfolio companies that they think they want a longer tenure to manage?
This will be a bit challenging, but possible. Well, first, a SPAC cannot be created with a specific transaction in mind, so that has been covered before. But the second, the negotiation between the SPAC and the target entity is very delicate because you would have a built-in conflict of interest.
Mm-hmm.
So there'd have to be at least some independent members of the SPAC sponsor to be able to figure out whether this negotiation is fair. Otherwise, if you're part of the management company and have an interest in the fund that you're managing, you're conflicted.
Yep. Yeah, a lot of investment bankers would be doing fairness opinions, I suspect.
Yeah. And the way I see it, like Eric said, you may be conflicted, but you're not restricted, right? So it could be done.
Yep. And I'm sure, having worked on enough fairness opinions in my life, there'll be one or two that get done. I think we're running out of time. So our time is up. I want to thank Eric and Chris. I thought obviously we could talk a lot more, but to the audience, I've learned more from Chris and Eric than I was able to find anywhere on the web. And my antiquated knowledge on SPACs was clearly out of date. Lots of things have changed that make the SPAC an alternative that everybody should know about. Thank you all, and stay well.
Thanks, John. Thanks, Eric.